Welcome back. You're still watching Business Morning live on Channels Television. Now to our next conversation. The Nigerian banking industry attracted about $1.47 billion as capital inflows in the first half of 2022. That's an increase of about 109.8% compared to $698.2 million received in the second half of last year, and 46.5% higher than the $1 billion inflows recorded in the corresponding period of 2021. Let's drill down now on these numbers. We have Damilola Olukman, a financial sector analyst at Chapel Hill Denham. Join us right here. Great to have you.
Yeah, thank you for having me, Ladi.
Yeah, so Damilola, looking at these figures now, what does it tell us? We're seeing quite an increase there, and the banking sector getting the chunk of data inflow.
Yeah, over the past few months, starting from 2021, the banking sector, has been at the front burner of driving capital flows, into the Nigerian economy, especially given the renewed, interest in Nigeria's fintech space. So we've seen big venture capital firms, outside of Nigeria, and also angel investors, just pumping money into the fintech space. And, that continues to drive significant foreign inflows, into that segment of the economy. And if you also recall as well, the last half of 2021 as well, also saw massive inflows, into the banking sector as well, largely on the back of the various capital market issuances, particularly on the external leg, we saw last year. Access Bank, last year tapped into the Eurobond market. UBA Fidelity Bank, we're also recipients, in that market as well. And like I mentioned before, coming from the second half of 2021 down into 2022, we've seen strong flows just come into the Nigerian banking sector. And given the low base in the first half of 2021, so that sort of bloat the numbers, we saw for the first half of 2021. But if we were to do it comparing with what we saw in the second half of 2021, then the numbers might not be as high as what we saw. Yeah, but it's good news. It's positive for the economy, and I think it's something to cheer for investors.
Quite positive. But do you see that carrying on, going further into the year?
Into the year, given the higher interest rates and the reverberating effect, that has on Nigerian corporates, particularly the banks, I don't expect to see sizable Eurobond issuances. That's if we even have any, given where yields are at the moment. So the major channel for capital flows, will still be angel investors or large venture capital firms, just pumping in money into the fintechs and into the and into other financial institutions. And given that we will not see capital market flows, capital market related flows, into the economy, I would expect the number to be somewhat elevated. So compared to what we see in the second half of 2021 and also coming into first half of 2022, we might just see the number, flatline or moderate, slightly, given the persisting macroeconomic conditions.
Right, and looking at some of these banking stocks now, we've been seeing they've not really performed well this year. Talking about the NGX, what's happening with those stocks?
What would imagine that a market that has delivered about 17.09% year-to-date performance, what would imagine that the banking sector would be at the front burner of that index, performance. But then what we've discovered is over the last 3 years, the telecom sector has gradually replaced the banking sector as the major driver of the index performance. And we are now beginning to see investors, tilt their interest from the banking sector to other sectors of the economy. For 2022 specific, the interest we've seen in the Nigeria's equity market, has not been well spread. We've just seen investors, pitch their tent towards sectors that are recovering and sectors, that promise higher, significantly higher earnings growth. And if we are to look at things from that perspective, the banking sector, given the lingering challenges, does not have so much to offer, for investors. So what we are seeing at the moment is various investors, are just selling off their banking sector stocks and are buying, pitching their tent, with telecom sector stocks, like Airtel Africa and MTN, and also some consumer names as well, which are on the path of recovery, in 2022. So that likely underscores the lackluster performance, we've seen on the banking sector names so far in 2022.
All right, with some of these big banks, not released their earning reports yet. What are your expectations, for those earnings?
For half-year earnings, we expect a somewhat bittersweet experience, for banks. We've seen interest rates, just crawl up from where they were, last year. The Monetary Policy Committee, has increased interest rate by 250 basis points, and that has severe implications, for banks. And for us, we think the tier two banks, which have more expensive deposits, will be at the receiving end of the Monetary Policy Committee's decision. So in terms of earnings, we might start to see moderation in earnings, for most tier two banking players. And for banks like GTB, we are expecting to see significant rebound, in their earnings, given the low base last year. And we think the interest rate trajectory alongside the FX outlook, if you see significant depreciation in the FX, at the high end window, we think those two factors, would be the key drivers of earnings, for banks going into this year. So while we expect the tier one banks to perform quite good, on an half-year basis, we think the tier two banks, might experience some pressure, and going into the rest of the year as well, that might also impact earnings for them. So for us, we think it's a good and bad story depending on which bank and their size.
And recently we saw the MPC raise rates, about 2 rate hikes we've seen. How has that impacted the banking sector?
Yeah, like I mentioned before, I think it's going to impact the banking sector earnings. If you look at a bank like GTCO, for instance, that has retail deposits constituting about 80% of their overall deposits, we think the impact, on that front will be a lot muted. When you compare it to other tier two banks, with an average of retail deposits of about 50 to 60%. So for us, like I mentioned before, I think the tier two banks, will be at the receiving end. But then on the good side as well, we also expect to see upward repricing in loans, which is also positive for earnings for banks. And we expect to see asset yields, also expand as well. Because what we have at the moment is fixed income instruments, ticking higher, which would mean that on a year-on-year basis, if you compare the interest income from fixed income securities for bank, we expect that to also come in higher, this year, given where interest rates are. So we think the net impact of that will be somewhat positive for the tier one banks who have sizable balance sheet to reap dividend, from the higher fixed income leg, and who would also suffer little impact, from the funding cost leg as well. So we think the net impact, for most tier two banks, might be negative, while tier one banks, like GTCO, Zenith Bank, UBA, FDNH, might be at the receiving, might perform, better, compared to their tier two counterpart.
And looking at the international debt market now, we're seeing, most of these countries hiking rates. How do you see that impacting the Eurobonds market?
Yeah, it has impacted the Eurobond market, significantly. Access Bank last year, issued 2 Eurobonds. The Access Bank perpetual Eurobond, was issued at 9%, and the 5-year Eurobond, was issued at around 6% levels. But it will surprise you to know that due to the translation effect impact of the higher rate in the developed market, we've seen those Eurobonds, expand to double-digit levels, which, depending on how you see it, can be positive or negative for investors. For investors who already bought these Eurobonds, when they were single digit, it might be negative, that's looking at things from a mark-to-market perspective. But then for investors who are looking to position or who are looking to invest, at the moment, they could get those instruments, at cheaper levels. So for us, we think the impact of just driven Nigerian Eurobond yields, have expanded Nigerian Eurobond yields, across the curve. But then when you look at the risk environment, for most Nigerian banks, we think this Eurobond yields, might be overblowing things, out of proportions. For most Nigerian banks, their capital adequacy ratio, at very impressive levels. And we don't see any significant threat, to their earnings, going forward. So whilst yields have expanded, we think it's a good entry point, for investors looking to pitch their tent in that space.
All right, Damilola, we'll keep tracking that industry. Thank you so much, Damilola Lukman, a financial sector analyst, Chapel Hill. Dan, it was great having you.
Thank you for having me, Ladi.
All right.
Have a nice day.
You too.